Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. This is Shane Chu. I'm the moderator for these sessions. So today in this Bursa webinar, we are going to explore this title, which is Investing Opportunities in a Post-Pandemic World. All right. So I guess many of you here often have the questions like which industry is hot right now, which sector has momentum, which sector is undervalued right now, and which company has the greatest potential. So these are the questions that retail investors like us always face when it comes to investing. So today we have invited a very renowned speaker to share with us his view of the potential opportunities, investing opportunities in the post-pandemic world. All right, so if you are ready for this session, if you're geared up for this session, type ready, okay, in the comment and let me know if you're ready for these sessions. So this is going to be a very insightful sessions. All right, cool. Thank you so much for all your response. Yes, good evening to all of you here. Yes, ready. Okay, ready to rock the house. Okay, David, are you ready too?
Yeah, Shane, ready to rock the house.
All right, cool. Now, as usual, before we begin, disclaimer, whatever we share in this webinar is only for educational purpose. So in no way that we give any recommendation to buy or any recommendation to sell in this webinar. So if you decide to do any investment decision after this webinar, so you're 100% responsible for all your investment decisions. Is that okay? Now, allow me to introduce our honorable speaker today. Okay, an engineer by training, David began his career as an engineer in the telecommunication industry for 10 years before turning to his passion in value investing. So he served as a director in the local equities education and research firm for 3 years, managing research efforts and delivering advanced value investing and portfolio management education series. So thereafter, he stepped out to pursue his own aspirations, establishing the Spiral Thinker Group, a collaborative alliance to promote intelligent value investing and develop algorithm-based adaptive portfolio strategies for sustainable long-term wealth creation. So David is now a full-time investor and dedicates his time and resources to nurture the youth in financial literacy. So he's often invited to speak in broker seminars, webinars, as well as other Bursa endorsed events. And his professional comments and opinions on value investing are featured in business publications like Focus Malaysia. So David also provides consultation services in value investing and advanced portfolio strategies for high net worth individuals. So today we are very excited and glad and honored to be able to invite David to come to our Bursa webinar to share with us his perspective in the potential opportunities in the post-pandemic world. So without further ado, let me hand over the session to you, David. The floor is yours.
All right, Shane, can you enable screen sharing, please? Thanks a lot.
Yes, you may share your screen.
Thank you once again for that colorful introduction. I think I need to reduce the number of words so that make your work easier. But anyhow, always glad to come back to the LifeChamp as well as Bursa Malaysia's webinar series. I'm always glad to be here to share my experiences as well as the research output for my team. All right, and I think it's just it's a very opportune time, and with the MCO being reinforced again, and with the number of cases going up each day, right? I think today we just hit the 6K mark, right? And what is that? This number is going to go up. If only our KLCI is going up like this, right? I think everyone will be feeling much better now. Yeah, but anyhow, just be careful. Outside, the pandemic is not over yet. And I think this is the right time for us to talk about these investing opportunities in the post-pandemic world. Now, but before I start, maybe just a little bit of update of the Spiral Thinker Group. So the Spiral Thinker Group has a few business units. One of them is called Gamma. Gamma is our education unit, whereby we have our investing, intelligent value investing crash course, as well as our new Chinese group called 投资. or I squared. So if you want to know more about what we do, head on to our Facebook, the link below here. All right. So without much further ado, tonight our topic is called investing opportunities in a post-pandemic world, and these are the topics that I'll be talking about for tonight. Hopefully, I can wrap things up in slightly over 1 hour. Yeah. But I want to perhaps before I start, maybe just pose a question to the audience tonight. Now, I think this is well, when I did the slides a couple of weeks ago, this seems to be like a pretty good question, but now I think about it, kind of sounds kind of silly, right? Because the answer is so obvious: is the pandemic over? I think as long as you are living on Earth today, right, it's very, very clear that the pandemic is far from over. But interestingly, just not too long ago, a couple of months, say, or towards the end of last year, or even the first couple of months of 2021, most of us in our mind, we feel that, the pandemic is finally over. Life's gonna finally going back to normal, right? And lo and behold, as things turn out, right, I think it's very clear to us now that the pandemic is far, far, far from over. But that does not mean that there are no investment opportunities. That's why we're here tonight to talk about, where are the pockets of opportunities for us to put our hard-earned money on, right? Okay, so to answer this question, probably let me just give you some visuals of what's happening to the world, not just Malaysia. This is some visuals that I took from dw.com, a pretty informative website. As you can see here, by the colors, right? Deep red means countries that have twice as many cases as 2 weeks ago. Now, by the way, this infographic was captured on week 18. Now is, I think, week 21. So this is about 2-3 weeks ago. And as you can see from the map here, right, countries like India, Iran, a lot of countries in Africa, all right, in big part of ASEAN as well, including Malaysia, we are having more and more new cases. In fact, some countries are having twice as many cases compared to a fortnight ago. And why is this happening? Well, before I bring the virus back on my slides, right? Perhaps one of the main reasons why this is happening is because this is just my personal opinion, but I guess it's logical. The world is not united enough to fight this pandemic. Last year in 2020, we were very united. Countries around the world, were locking down, governments were closing borders, everything was halted. But that came with a price. Yes, we managed to curb the transmission of the virus, but at the same time, we had to pay a big price on it, which is the economic shutdown. But then governments and central banks came to the rescue by pumping a lot of money, right, to stimulate consumption. And that's how we went through 2020 in a nutshell. So in 2021, I guess a lot of us think, last year was not too bad, So a lot of us became complacent. And I guess that's one of the reasons why there are multiple resurgence of these infections all around the world. Okay, and this virus, right, is actually a very, very smart virus. I laid out some of the key facts that I personally have researched about this virus in this slide. Now, first of all, the official name for this COVID is actually SARS-CoV-2, or severe acute respiratory syndrome novel coronavirus 2. All right, first and foremost, this coronavirus is zoonotic. Now, what is the meaning of zoonotic? Zoonotic means this virus can jump, okay, for the layman's, could jump or transmitted between humans as well as animals. And that is what makes mutation possible, all right? Imagine when the virus jumps from different people, different people from different countries, then from animals, then back to people again, there is bound to be some sort of mutations in the structure of the virus. And these structures are, I think most of you know this, have seen this picture somewhere or in the internet. This is like a representative visual of the virus. Of course, it doesn't look like this, but what I want to highlight here is actually the yellow spikes. These are the protein spikes of the coronavirus. And when mutation happens, most of the time it happens on these spikes. And why is this important to know? When mutations happen, right? Because these are the spikes that is responsible to attach the virus, for the virus to attach itself to our body, human cells, that it can transmit into our system, right? And why is this mutation so important? It's because as long as the viruses keep on mutating, right, then it makes vaccination or even finding a cure more challenging. And that is why with whatever strategy, vaccination strategy that we have, the treatments that we have, right, it may become obsolete if we do not stem the mutation, right? And the third picture is actually a picture of Dr. Larry Covey. He because of this pandemic, he was thrown into the limelight. He's a fellow virologist in Fred Hutchinson Cancer Research Base in Seattle. He had this very famous quote saying, "Never underestimate your pathogen." And I guess this is a very good reminder, because I think a lot of countries, a lot of people around the world, we have been very much complacent, and we have taken, underestimated the power of this virus. Now, I think it is becoming more and more apparent or likely that this coronavirus will eventually, it cannot be wiped out entirely. Even so, it will take years, if not decades, of research as well as testing of the cure or vaccines, right? So for the time being, it's very highly likely that it's going to become an endemic eventually. Now, what is an endemic? An endemic is a disease that is not completely eradicated from the face of the earth. It still exists in different pockets around the world. Examples of endemic are like chickenpox, like malaria. It may not happen everywhere in the world, but it may happen in certain places, certain regions, certain countries, or to a certain population. But with the proper vaccination, it should be able to stem it from becoming a epidemic or pandemic, right? So look, based on what we are seeing now, looks like the COVID-19 is likely going to become endemic, which means that it's not going to end soon, right? So then you can ask, hey, but how about the vaccinations? Shouldn't the vaccination help to stem? Yes, partly true. Now, a lot of us think that, or mistakenly think that, the vaccine is the all cure for this virus. Actually, it's not that. It's not so. The vaccination or the inoculation exercise is to slow down the transmission of the virus, the infections among the population, so that eventually when we hit a certain scale, then we achieve what is called herd immunity. In the science or medical community, they peg it at around 75% to 80% of the population being vaccinated. That is when we can start to achieve herd immunity. But anything before that, right, it is still very much a danger zone. And to make things worse, the world is not a fair place. Okay, as you can see from the bottom right of the slide here, how vaccine is being produced or being supplied to the world, right, actually is very skewed towards developed countries. In fact, some countries, as you can see, are having more, they are storing more than one vaccine per population. Let me give you an example. Israel has the highest share of total population that receive one vaccine, right? And in fact, countries like UK, US, right, they have, and even Canada, they stored so much more vaccine that is what required. Whereas poor or developing countries, they have much less. And in fact, they have to wait in line to receive their vaccines, vials from the producers. And like it or not, well, the Western world like to point China, say, it's China's fault, right? But if you look at things, yes, China could be the start of the epicenter, but China is not entirely responsible, for what happened since last year. In fact, by look at the vaccination production, right, you can see it's very clear that all of the vaccines produced in US alone is being used domestically, which means that all the vaccines produced in US are not exported as of March 2021, based on this report by Airfinity. But I'm sure eventually US will have to export some of the vaccines that they produce because they have much more than enough. Now that doesn't mean that US pharma companies like Pfizer or Moderna, they do not produce, they only produce in US. No, they also produce in other countries like UK, European countries. Even, in fact, I think recently Singapore just announced that they are trying to woo, I think Pfizer to, or Moderna, I can't remember, to actually set up a production facility in Singapore, right? And interesting, you can see that China is the most generous. In fact, China produces the most and they export the most as well, okay? But what is important here is actually this infographic, this table, which is available by the Straits Times. Sorry, this Straits Times is Singapore Straits Times, not our Straits Times. In fact, you can see that in order for herd immunity to be achieved, which means 75% of the population to have at least one dosage of vaccination, Malaysia will take about 5 years, which is agak or more or less there, because I think based on my last check, a total of 1.23 million Malaysians have been vaccinated so far, having at least one dose of vaccine, regardless of the brand. So which means that we have about 4% of our population which are being vaccinated today. Now, if you extrapolate that and assuming that we have a exponential vaccination numbers going on, we should at least need to wait 4 to 5 years, before herd immunity can be achieved. So don't take down your defenses too soon. We still have a long way to go, and we still have a long fight ahead of us. Not just getting the supply of vaccine, but many things as well. Okay, so but that aside, now the vaccine aside, let's take a look at how the world economy has performed last year. Now, based on I think IMF or World Bank data, last year the global GDP was forecasted to have lost about 3.4%. All right, due to the pandemic. Now, what does this mean? How does this translate to absolute terms? Based on if we use 2019 as a reference, right, a 3.4% drop in economic growth translated to almost $3 trillion in economic output. That's how much we have lost last year, the opportunity cost. Okay, but then again, as you can see from this graph, right, the harder you fall, when you do bounce back, eventually you bounce back hard as well. So let's zoom into Asia now. So this is based on the ADB, Asian Development Bank statistics. The projection. Yes, last year in whole of Asia, the only two countries that registered positive GDP growth is actually China and Vietnam, for all the reasons that we have known. China is the first to announce, is the epicenter of the COVID-19, but they are also the first to successfully curb the transmission of the virus. And that's why they were able to resume manufacturing. They were able to resume a lot of employment as well as social activities, and that's why they rebounded the fast, and that's why they managed to achieve positive GDP growth last year. And whereas other countries, Indonesia, Malaysia, Thailand, the tigers of Asia, right, all GDP were down. Malaysia is not too bad, not as bad as this Philippines. Philippines was down 10%. And I think 2021 is also expected Malaysia to the GDP growth to be between 6 to 7.5%, which is not too bad, all right, considering. But that, of course, is a projection. Whether we will achieve that, it depends on how well we will curb the current situation, how we manage the current situation right now. Hopefully, our government will learn from the lessons from last year as well as the lessons from other countries to really do what is necessary. Okay. So I'm not sure if you guys remember my last Bursa webinar last year about sustainable long-term investing with fundamental analysis, I introduced these two cycles called the vicious cycle, or AKA the recession cycle, again, as well as the virtuous cycle of when recovery happens. Now, I want to put this into context of 2020. In 2020, as we know, right, we went through a vicious down cycle in terms of economic output, right? That's why I talk about the loss of 3.4% in global output, right? So what happened? It was actually because the lockdown, as I mentioned earlier, the lockdown, yes, managed to stem the transmission of the virus, but the price that we paid was a total lockdown of economic activities, which means that, with those lockdown, consumptions halted almost overnight. All right. Never in my life had I heard of or seen aeroplanes grounded on the tarmac, for months, not just weeks, right? So which led to a shortfall of consumption, and when that happened, productivity falls, employments drop as well. That's why U.S. Not just U.S. countries around the world, we've seen the highest unemployment rate in 2020. The income falls, and this cycle will repeat. Will go on and on and on until the situation improves. But what happened last year was, because it happened so abruptly, the lockdown as well as, the economic halt around the world, that governments and central banks step out, to curb, to help stem or prevent any economic crash, systemic and economic crash around the world. That's why they were pumping a lot of stimulus money. Central banks easing, I'm not sure if you remember the moratorium programs, reducing interest rates, pumping money into the system. And governments also have a lot of very stimulative fiscal policies to help rejuvenate the economy. But there's a problem here. As you can see, actually, whatever they're trying to do, they are only trying to sustain consumption. They are not really, because of the lockdown, productivity went crashed, unemployment shot to the roof. So they were only trying to solve, or they were trying to amend the situation by stimulating consumption. But they know very well, and we know that this cannot be long term, because in order for a recovery to be truly sustainable, right, productivity has to rise, employment needs to come back, then income will slowly rise, which will in turn spur consumption. Okay, so is the situation as bad as last year? Thankfully, the answer is better this year. In fact, for the recent couple of months. This is a report. This is a statistics compiled by McKinsey. I've been following McKinsey quite a lot because of the pandemic. I think their reports are very, very intuitive. This was the latest one. So they did a survey of I think, don't know how many executives or how many companies around the world. By polling, say, hey, how likely are you to increase your workforce? Are you staying status quo, or are you even decreasing your workforce? So of course, last year June, right, things were pretty bad. So about 40% of the company's poll or the executive poll, they say, oh, sorry, we are actually downsizing our workforce. But as you can see here, along the quarters from June 2020 until today, right, until as recent as April, the dark blue bars are actually decreasing. All right. Of course, the status quo is almost the same, but the good news is actually more and more companies are increasing their hiring back again. All right. Now, why this is important? Remember, if you come back to this recovery cycle or the virtuous cycle, right? When employment increases slowly, then systematically the income of the population will also rise meaningfully, right? And when this happens, the consumption will come back, productivity will come back, will improve. Then in turn, there will be more job opportunities. Then income will continue to rise, consumption continue to rise, so on and so forth. And that is how we can slowly slowly transform to recovery cycle. Okay, it's not going to happen overnight. It's going to take months or even years. Okay, so don't jump on your wagon. All right, but I think this, it doesn't mean that it's not a good time to talk about investment opportunities, because you've got to arm yourself. You've got to arm yourself with knowledge, or at least some sort of inclination of what can be invested, you know, when recovery does happen and when recovery is more certain. All right. So before that, let's take a look at what are the long-term impact on the economy because of the pandemic, because of lockdown, and what are the implications to our economy, right? So let me just start with by giving you guys a disclaimer. I'm not an economist. I'm just looking at this from my own lenses, from my own investors' lenses, based on my experience, based on what I see, based on what I read. So I categorize to these, impact or factors, into two different groups. A group that I'm quite certain about, and another group that getting a bit blur. All right. So what we are certain about is I think in all our heads is we know that COVID-19 is far from eradication. As I mentioned earlier, chances are it will become an endemic in the near term. Then of course, I think a lot of us are getting more and more. I think there is a typo here, a spelling mistake. The adaptation to new norm is more apparent now. I think all of us, I think most of us are still working from home. Kids, I think my kids are still having the online classes, and this a lot of activities, social activities that we used to, is still not back yet. So I think a lot of things are new. This is the new normal. Okay, I think digital transformation there's no doubt about it. More and more companies are, embracing, it. Perhaps last time they're trying to push this back because of, no money, no capital, right? But now they've got no choice but to embrace digital transformation, but to accelerate whatever that they need for their business to survive. Okay. And I think we are also quite certain that countries around the world, or even central banks around the world, including the West, the developed nations as well as developing nations like Malaysia, they are going to still going to stick to accommodative policies. So these will include both the monetary as well as fiscal policies, because as I mentioned before, in order for this recovery to be meaningful, all these four factors has to happen meaningfully, right? So I think policies will still be accommodative until the signs are clear. Last year, I thought that lockdowns it's a thing in the past because of by looking at what we went through last year, towards the end of last year. But these couple of months showed me that actually we are very wrong. In fact, lockdowns can happen and should happen in some places, some countries, or even some states, okay, to curb the rapid transmission due to the variants, the new variants like the Brazilian or even Indian variants, okay. Because of all these, stock markets is going to continue to be volatile. So for those of you who hope that stock market is going to be more calm this year, well, I think we have to do some reality check again. I think these few days is open our eyes again, right? Stock market is very, very volatile. In fact, one day can be up 1-2%, the next day can be down 3%, and this will again continue at least for the next few months to come. Okay, border reopenings is becoming further and further. I thought that some countries will actually happen in some countries, especially with the vaccine passports or even the travel bubbles. But seems that right now with the variants, especially the Indian, the B1.167 right variants, I think this is becoming more and more challenging for countries to open the borders, right? Even some countries are starting to point their fingers at each other now. If you are following, the latest development in Singapore and India. Vaccines efficacy is, will always be a big question. People are starting to say, hey, how come I'm vaccinated, but still I can get infected? All right, for the reasons I shared earlier. In fact, I think the narrative of, the risk outweighs the benefits outweighs the risk, right? Could, will be always come into play, because lately a lot of vaccines, a lot of reports came out to say that some vaccines may lead to blood clots and things like that, or other, side effects. Alternative treatments last year used to be quite mainstream, like the plasma protocol. But these days, I think recently they basically took out this protocol, say it's not effective at all. So this is a big question mark. And last but not least, global economic recovery is still a big question mark. When it's going to happen, how fast it's going to happen is still a big question mark. And the long-term economic damages is still very, very hard to assess. Right? Yeah, I think more and more information or more realizations will come along the way. But right now, we can be sure that this is not the end. And in fact, we may not have seen the real economic damage caused by the lockdowns and the virus yet. Because again, as I said, countries, governments, and central banks around the world are still very accommodative. They're still very easy on the policies. So we have yet to really feel the real impact of these economic damages, right? And what are the structural implications? I think it's very clear now. Actually, the supply chain is in a mess right now. In fact, I think supply chain is also very timely to be overhauled. And supply chain management used to be driven by economic reasons, but these days national security also come into play. So this is another new factor that we have to input into our models or investment consideration next time when we want to choose which country or which sectors to invest in. Workplace and manufacturing automation, as I mentioned before, digital transformation is here. Is actually very, very important. And in fact, the economic lockdowns open our eyes, to show that actually to rely purely or entirely on human labor, right, is not efficient at all. And that is why a lot of companies, tech companies or semiconductor companies are coming out with a lot of automation solutions, which will hopefully improve our workforce. Business landscape, there's an overhaul, reset. Some businesses, they are gone for good. Some businesses thrive. Just take a look around. These days, when you go out, if you manage to go out, right, where do you go to? I think most of the time we go to groceries. In fact, a lot of people around me or even myself, e-commerce, a lot of more and more people are going to buy things online, transact things online. So there's a structural change in the business landscape. Labor economics as well is going through a reform. I think in terms of volume, in terms of numbers of employment, is still going to be low, but the wages may increase because of inflation and because of specialty, if you have special skills. And in this regard, I guess a lot of this informal employment portion or the gig workers, I think they'll still go through a hard time because restaurants are not fully open. Even if they're open, they cannot be open at full capacity. So I think a lot of these gig workers, is going to still face a high unemployment rate. So I think labor economics is also going through an overhaul. And because of these hardships happening all at one time, and it's still happening, it's getting worse for some countries, there are bound to be political instability. Change of governments is bound to happen, as history has taught us. And social unrest is going to become more and more apparent. Because of the population being fed up with the government, or governments who are not effective enough to combat the virus or to bring the economy back to the healthy level. So these are some of the structural implications that we expect is happening, and it is important for us to know this because this will again affect how we want to. Which sectors or which industries we want to look at when we want to invest in a post-pandemic world. Okay, hopefully you guys understand what I'm going, at least catch what I try to discuss here. All right. So before I go ahead, actually I want to talk about two unintended but quite serious consequences of the lockdowns last year, from chips to ships. I think all of you know this already. Because of the total lockdown last year, there were no new container being manufactured, and that is why this year, right, we suddenly, when economies were reopening, suddenly we find ourselves in a situation where there is not enough containers to ship our goods, you know. And in fact, some of these container rates have shot up to the roof, to 3 to 4 times higher compared to last year, right? Especially in the Shanghai, South American routes. Okay, and this is something that a lot of experts are saying is gonna be there for quite some time. It's not going to be resolved soon, even though a lot of these container suppliers they're working around the clock to actually build more containers to curb the demand, right? Then on the other hand, the chips as well, because of the lockdowns, right? Especially last year, a lot of automotive players, because they cannot sell cars, they suddenly stop the orders of the semiconductor chips, especially power management, sensors, things like that. But at the same time, because of the work from home culture, the rise of the work from home culture, consumer devices like computers, smartphones, even these mics, these cameras, high in demand. So a lot of these manufacturers, they suddenly shift the production to cater for these applications. Yeah. Then when the economy start to bounce back, suddenly, the automotive players found themselves, I'm not in a position where I do not have chips to actually assemble my cars. In fact, then they started to they started to order way ahead of what they need. All right. For example, if they need 1,000 units for this year, suddenly they may book 2,000, 3,000 units, because they're afraid that they're going to be short of chips to assemble their cars. And this has led to a chip shortage around the world. It's quite serious. In fact, I think this is from the latest report by Nikkei, some of the lead times may extend to 24 weeks to even 1 year. Now, this reminds you of what happened to the glove sector last year, right? Where, the lead time of some of the gloves, they reported lead time more than 1 year. And I believe this is happening to the chip industry right now. And this has somehow caused a lot of headache to the semicon companies, especially as well as the automotive suppliers. So I think this is also not going to be resolved quite soon. It's going to drag for at least for a few months. And if you look at this, what is the implication of all this? It's not just these two, but there are other factors as well. Then we will definitely find ourselves in an inflationary period. A lot of things are going to get expensive. Now, good luck to you if you find yourself at this time in need of a new laptop or in need of a new smartphone, right? Because things are just getting so expensive right now. In fact, I have a friend who owns a computer shop. He tells me that hard disk prices are going up every day. Not weeks or months. It's every day. Every day his suppliers will quote him a different price. And in fact, some of the computing processor chips like Intel are out of stock. It means that you have money. It doesn't mean that if you have money, you can buy. All right. So I think this will lead to a lot of inflation across the board. Yeah. Okay. So with that, I just laid out a big picture of what to expect, or what is happening, or of the observation. And why that is important, because we have to map that into investment merits or investment opportunities in the post-pandemic, even when things are really recovering, right? And that is why we're looking at this. And okay, things are not too bad. So I gave you the lowdown for all the bad news, all right, to shock you first. Now I give you the good news, okay? Based on the latest IMF World Economic Outlook growth projections, I think they released this only in April, so it's very recent. I think a lot of their projections are still intact, so they expect the world output to bounce back to 6% growth, with a lot of the growth coming from emerging and developing Asia. All right, so that's where Malaysia is, all right? So I think pretty happy, pretty fortunate. So on average, I think they expect the emerging in the developing Asia countries to bounce back about 8.6% year on year. Now, India was initially projected to bounce back the highest at 12.5, but I think with the recent, spike up to hundreds of thousands in a day, right? I think this may need to revisit again. Okay, but not fret not. I think chances are, compared year on year, we should be ending 2021 in a better position than last year. Okay, but hopefully countries around the world, including Malaysia, were able to can do a good job to curb the current rise. Okay, but if you look at the next window of 5 years, right, where are the countries that we should look at? In fact, we can look at this. This is I think from the same report, China alone, one country will contribute 1/5 or 20% of the world economic growth in between 2021 to 2026. And US is the next, about 15%, followed by India, Japan, and even Germany. And if you look at this chart, right, it's so clear that 4 or 5 countries as little as 3 or 4 countries contribute more than half of the growth of the world economic output in the next 5 years. So I hope that with this, it can give you a better idea where you should be looking at, which economies or which market you should be looking at in the next 5 years. For us, as Spiral Thinker Group, we are definitely looking at China. We are definitely looking at US as well, especially with the US-China trade tensions escalating. We believe that the supply chain, overhaul will actually produce a lot of opportunities for us to put our money, make some good money. Okay. And we always believe that crisis begets opportunities. In any crisis, no matter how bad, right, there are always sectors or always businesses that will benefit. And I think this is just a summary to get you guys, give you guys a good overall idea. President Biden has just took the mantle for a few months, not even 6 months. He passed 100 days. So we had to look at his policies. I think his policies will surround things like renewables, healthcare, infrastructure. He has a very ambitious infrastructure program to rejuvenate America's economy. And the US-China trade, US-China tension is not going to subside anytime soon. So these are areas where we can look at where I'm sure there are a lot of investment opportunities there. Post-COVID recovery, I think there's a lot of investment opportunity as well when it comes to pent-up demand. Pharmaceutical companies or even healthcare, hospitals, finance may bounce back once the economy recovers. Tourism, consumer, all right. Then, as I mentioned earlier, we're going into an inflationary period. So that's why commodities is going to go. The prices of commodities are going to go higher and higher. I think we are seeing already some consumer staples as well. As long as these companies can pass on the higher cost to the consumers, right, they should benefit in an inflationary period as well. And last but not least, this is very close to my heart. We believe in digital transformation and believe that this is only the inflection of the super cycle to come. So areas that we will be looking at are things like 5G. The adoption of 5G is going to be in exponential. Hyperscale data centers, electric vehicles, automation in manufacturing, automation in workplaces, supply chain overhaul. These are where we believe that a lot of tech or semiconductor companies are going to benefit. Okay, but of course, if you say, hey, David, but now tech are so bad, right? I think this is a good opportunity for us to look deeper into where we can invest. Okay, and probably I want to spend a couple of minutes to talk about this because a lot of us, when we talk about tech companies or even semiconductor companies, right? Of course, you think, hey, how about growth stocks has performed so well in 2020, right? But how about, can they sustain the growth in 2021? I think the short answer is because they've grown so much, they've grown so fast and so much in such a short time, right? Just by simply looking at the reversion to mean principle, right? I think that they are in a high time to correct. And but good news is I think value is going to catch up. So value stocks are companies that are trading below the intrinsic value, especially those for energy or finance sector, right? They should be able to catch up because of valuation. I think even at this moment, they don't command very steep valuation as compared to their growth counterparts like FAAMG, like the Amazon, Facebook, Microsoft, Google of the world, right? I think these stocks are going to come down because of reversion to mean. But we believe that tech on the long haul is going to be more and more important. So that is why for us as Spiral Thinker, we'll still be looking at tech, focusing on tech. But that doesn't mean that we will not diversify. Diversification is very important, as I mentioned in many of my webinars before this. So I'm going to talk a little bit about it again later on. Okay, so now let's move on to the recovery thematics that we are focusing on, or things that hopefully you can explore as well. This is a snapshot from my previous webinar back in April. The way we do research is actually we do a top-down first. So I gave you a top-down analysis, a view of what is happening just now. Then we can, by understanding the big picture, then we can do a bottoms-up, screen or filter of the sectors or companies or countries that we want to invest in. Okay, so there are several ways to approach this. For us as Spiral Thinker, what we do is every year, we put our heads together in a research team and say, hey, what are the sectors that we should be looking at? What are the sectors that we are positive about? So for 2021, so we are actually quite positive about, some recovery stocks, some technology stocks as well, which I'm going to mention later. Excuse me. Commodity upcycle. I think steel has had a good run this year. Healthcare stocks are even ESG related. Okay, I think we have a webinar next week about ESG. So make sure that you sign up or you register for this with Chun Xian. Okay, then sectors that were neutral. So which means that we won't be spending too much time or we won't be putting too much allocation on these, including construction, property development, banking and finance, automotive retail, for all the reasons that I shared earlier on. And sectors or companies that were negative, which means we totally won't touch, are those companies which are highly indebted, because with growth slowing down, but yet they still have to finance their debt, right? I think some of these companies may go into trouble. Travel related, tourism related, I think we believe that it's still a long way to go. Insurance as well, aviation. Okay, and for those companies that we want to look at in the positive column, right, or even, what are the criteria? So depending on which is your strategy, so whether you want to go for recovery stock or value stock, right? So these are some of the factors that you can consider. So for our own comfort level, we always look for companies with very strong cash generation prospects. As long as your company cannot generate cash flow from operations, right, that is a big no-no for us. So this is a very important criteria. Of course, ideally the company should be able to scale up in any situation. All right, their profits should be sustainable, meaning they are not too lumpy. They should be innovative, able to transform the business or even their business in bad times. They should be resilient, and of course they must have good qualitative merits, especially in the management, as well as how they go about with the business. So on the valuations, on the value side, of course, we hope to find companies with strong balance sheet. Now we are very greedy. We don't just look at this in silo. We want to invest in companies that exhibit all these good traits. Yeah. So apart from all these green factors here, we also hope that the company has strong balance sheet. Ideally, there should be net cash position, because we are very, very gassy, as Hawkins say, right? There should be, if not net cash, they should have the strong ability to service the obligations. they should have a sustainable burn rate, not like airlines. Airlines burn rate is very, very high. So which means that they are bound to, they are bound to find themselves, they need to raise more capital to sustain their business. So we want to avoid businesses like that in this pandemic era or even post-pandemic era. Hopefully it's cheap enough, price to value divergence, attractive yields, and it must have good quantitative merits, right? Like, PE, ROE, things like that. Okay. So these are some of the criteria that we look at, not all, but some of the key factors that we look at. And for tonight, I think almost time. So sorry. Tonight, I'm going to talk about 2 case studies with you guys. So I guess a lot of you are waiting for this part of the webinar. I'm going to talk about one case study in the recovery theme and another in the technology, the digital transformation theme. Okay. And first and foremost, I'll talk about the recovery. Now, a lot of people, when they talk about recovery, they think about retail, they think about, airlines, travel, they think about consumer. But for us, we go a few layers deeper down. We try to look for sectors or businesses, that will benefit regardless of industry across the board, And one of the sectors that we found is actually petrochemicals. Now, before this, you may think, petrochemical is all about plastics, right? Because because of the convenience economy, on the move economy, on the go, right? Everything we need to be wrapped in the plastic. Even e-commerce these days, more and more people buying things online, right? So a lot of things are being delivered in plastics or in shrink wrapping, right? But petrochemicals is much more than that. In fact, petrochemicals like our palm oil, right, is in every day, is in all the things that we use in our life, from packaging to food and drink to even our electronics, our consumer devices, our batteries, tires, every single thing that we use, all right, day in, day out, from the time you wake up, brushing your teeth to go to work, or even these days working from home, to when you turn on your computers, all right, all these have all these products that we use every day has petrochemicals products on it, okay? And in fact, petrochemicals is going to be so much important because based on the 2018 paper by IEA, the International Energy Agency, they project that by 2030, 1/3 of the oil demand is going to come from petrochemicals, not from land transport anymore. In fact, the demand for land transport, as you can see here, especially the ICE or internal combustion engine vehicles, is going to be less and less because of hybrid or EV cars coming on stream or battery operated cars coming on stream. I think I'm just sharing some of the projections here. I think by 2035 or even 2040, there'll be a crossover whereby there'll be more electric cars on the road than internal combustion engines. And back to the IEA projections, in fact, the project by 2050, nearly half, of the oil demand or even gas demand is going to come from petrochemicals. All right. And as for all the reasons I mentioned, right, petrochemicals are getting more and more important in our lives. All right. In fact, based on this European Commission paper, they project that for the next few decades, right, the demand for petrochemicals is going to rise in most of the continents except for perhaps Europe, because European countries are very concerned about environmental impact of this production of petrochemicals. But if you look at developing nations or developing areas like Asia Pacific or Middle East, right, the consumption for petrochemical is only going to grow. It's only going to rise. I think so. We are in a very nice spot here because Malaysia is part of Asia Pac, and Asia Pac is one of the countries that will have a very huge rise in the petrochemical demands. So these are just basically talking about primary chemicals, which include the HVCs, the high value chemicals, the basic chemicals, ammonia, methanol. Petrochemicals is much more than that, which I'll explain a little bit later. Okay. And for that, for this investment thematic, one of the companies that we have been looking in since last year is actually Petronas Chemical. Now, perhaps some of us may think that Petronas is just an oil company, which means that they try to dig oil, look for oil, then refine it to become the petrol that we pump on the station or gas that we use to burn, for our kitchen, right? But actually, Petronas has a lot of business units, and one of them is actually petrochemicals. All right. And this company is called Petrochemicals Group Berhad. Let me give you an example of observation why petrochemicals is so important, right? In all this business, right, the margins are very thin and they are very competitive, especially for the refinery. So if a oil company does not have a petrochemical arm, right? Actually, the business may not be able to sustain because the margins at the other units are very, very thin. So much so that recently Petronas, they actually divested their investments in some of the subsidiaries, including MISC, including PetGas, including Petronas Dagangan. But they did not sell a single share in the petrochemical business. So that shows you how important the petrochemical business is for Petronas. Yeah. So actually, I'm very proud. Actually, we have a very, very strong petrochemical company in Malaysia. Petchem, or in short, is one of the largest integrated chemicals producer in the whole of Southeast Asia. We are the 4th largest methanol producer in the world. There are so many merits. Yeah, and the products that are the products by petrochemicals are being used all over the place, from polymers to plastics to methanols, to product application in construction, electronics, our home appliances, packaging, automotive, personal care, pharmaceuticals, agriculture, textile, you name it. They are bound to be petrochemical products in the process of producing those products. Okay, and that is why this is a very good company. In fact, it is an investment grade company, right? So what are their growth catalysts or their growth prospects? Petchem is not just a company that produces basic chemicals as well. In fact, they have their two-pronged strategy for growth. As you can see here, this is taken from their annual report for financial year 2020. Now, vertically, they want to grow from a local business to a international business by become export as well. Then on the horizontal side, growth, they want to grow from a basic petrochemical, as I mentioned just now, to a specialty chemical producer as well. Now, why this is very important? Number one, because specialty chemicals products are less competitive. All right, that's one. And in terms of they can command higher margin because they require higher quality manufacturing, flexibility, delivery time, and customer service. Okay, and this is where they can they can advance up the value chain for their business. As you can see, they have a multi-decade plan. I think in the next 20 years, they want to become one of the top specialty chemical producers in the region. So imagine if they are able to do this. I personally believe they can, because they are a very well-run company. So I believe that business will grow in terms of volume as well as in terms of products. Okay. And if you look at the price chart, if you ask me when is the best time to buy Petronas Chemical, based on hindsight, of course, it was last year when everything crashed right at the end of the world. If you draw a long-term price chart since I think this was the IPO, yeah. In fact, as last year, sometime in May, April, right, when the price was 4 ringgit, right, actually it is almost the same price as more than 10 years ago, almost 10 years ago, which means inflation is zero, excluding dividends. But of course, including dividends, we're looking at 6.6% per annum growth, CAGR, compounding annual growth rate. Now, as you can see just now, remember the merits that we look at when we want to invest in stocks, right? One of the things that I really like about Petchem is they are net cash company as of the latest 3 years. As you can see here, their blue bars, which is the cash equivalents, are higher than their total liabilities. I repeat that. The cash are more than their total liabilities. That shows how strong their balance sheet is, which means they should be able to sustain any downturn of the economy, right? Yes, the business is going to get hit, but the business should sustain. Okay, and if you look at this, they are also very strong in cash flow generation. If you compare the green bar here to the black bar is the net income. Their cash flow, they are always able to generate more cash flow than the net profit for many years. So Petchem is an investment grade company, and the beauty of it is it's very cyclical. Now, why do I say it's beauty? Because of the cyclical nature, we can trade, this stock along the way, and that's why it's so great. Now, I think I took this snapshot back in 25th of March, about almost 2 months ago. But the price is still about $8 today, right? Even lower than $8 today. So I think this price chart is still very much relevant. Okay. Right, so that's the end of the first case study. I just give you a very basic introduction of the petchem industry. In fact, I think last year we did a 2-hour introduction on the petchem chemical in our group to our members. Okay, the second case study I'll look at is actually the technology space. With the digital transformation, which company is definitely, we are very certain going to benefit, with the rise of automation, with the rise of digital transformation, acceleration to adopt digitalization in the business processes. And we believe that one of the sectors or one of the industries that we should look at is the data industry. Okay, in particular, data storage. Right now, what we're going through is actually what we call the implosion of data, the explosion of data, right? With 5G and Internet of Things. I think I talked about this last year in one of my technology webinars with Bursa. So this is just a continuation of it. And with the pandemic, it actually accelerates the adoption of this digital transformation, right? So the importance of data is only going to be more and more apparent. Okay, and in this whole paradigm shift, right, one of the segments that will really benefit is actually the data storage. Well, of course, more and more data will be created because more and more devices are coming online, but this data has to be stored somewhere for post-processing, for archiving, right? So this is where the storage media will play a role. Our hard disks, our NAND, DRAMs, SSDs, right? So in this regard, I think based on the latest report by IDC and Seagate, they believe that in the next few years to come, right, the importance of edge and as well as core computing or core network is going to become more and more important. If you imagine as our devices become more and more complex, our smartphones, our computers, our smartwatches, our wearables become more and more smart, right? A lot of computing power cannot reside on the device itself. It has to pass on to a more powerful machine, which may sit on the edge or on the core. That is why when these devices pass on the data, right, there needs to have a certain storage media or storage system. Right, that is why they projected such a huge growth. In fact, they say that by 2025, there are going to be 175 zettabytes of data, created in 2025. Do you know how much is 1 zettabyte? 1 zettabyte, ladies and gentlemen, is 1 trillion gigabyte. And by 2025, they expect to have more than 175 zettabytes. Now, would you like to know what I think? I think this is underestimated. I think this number is going to be much, much bigger than this. Because I did research on, when I was an engineer in Maxis, and the potential of data growth just dumbfounded me. And I believe that when the time comes, right, this number is going to be much higher than this. So which accentuates the importance of data management, and that is why hard disk comes into play. Then you may be asking me, hey David, hard disk is such an old technology. Is it still relevant? It's both true and not true, because as you can see from this chart here, hard disk HDD, which stands for hard disk, hard disk, right, is still very, very much relevant when it comes to storage media. Why? It's very simple. It's all because of economics. Now, in fact, if you look at this dark orange, right, it's tape. tape, is the cassette tape, but much bigger version and much bigger in size, right? They're still very much relevant because they're so cheap, and for the same reasons, the HDDs is going to still going to remain very important. Yes, SSD is catching up, but because of cost, because of complexity of the of the product, complexity of the system, right? I think there'll be some time before SSD can catch up and eventually replace HDD entirely. I think HDD is going to have another few years of good run on this. Okay, and in this space, we have a pretty good we have a company in Malaysia, not just one, not just this one. We have a few. But one of our favorites, based on our research, is this company called Dufu Technology. Now, Dufu Technology is a KLSE, listed KLSE. This is one of the main HDD component supplier listed in KLSE. And what they produce is they produce the disc spacers, clamps, as well as coil motor spins. If you look at the picture on the left, right, so this is a very simplified, component of a hard disk, right? The mechanical components of hard disk other than the disk, right? So we've got these spacers, we've got these motor spindles, we've got this gimbal, all right, arms, we've got these clamps, right? So what Dufu specializes in are these spacer rings. Now, let me tell you why this is so important. Look at this picture on the bottom left, right? They are basically the keratan rentas, the I don't know what you call it in English already, the diagrams, of two different types of hard disks. All right, now physically, they are the same. They look the same to us. Why? Because their thickness is the same. But internally, you can see that these two hard disks, they are totally different. The one on the left has a capacity of 10 terabytes, spread over 7 disks, or what they call 7 platters. On the right, although they're physically the same, but this hard disk has a capacity of 14 terabytes spread over 9 platters, and the medium is helium filled. Now, this is a very important picture. Why? Because as this demand for hard disk drives grow, right, I can tell you what we are observing is actually in terms of volume, they won't grow so much, right? Because the modern hard disks will actually be packed with more disks, which means that they will have higher capacity, although physically they look the same. Okay, and this Dufu is in a very special situation, or they are they have a very strong competitive advantage. Why? Because they specialize in this thing called the titanium spacer. Remember? Now, we want to squeeze more discs or platters into the same physical space. These small parts, right, become more and more important, especially the spacers as well as the clamps. Okay, and with new materials, a lot of previously the hard disks a lot of them are actually produced by aluminum substrate, but the new hard disks, HAMR, the MMR, are being produced by glass. This piece of disc is normal aluminum, it's actually glass. And in order for that to when the trend shift towards glass disc, right, then you need titanium or even advanced alloys to actually be housed into the same enclosure here. All right, and that is why we believe Dufu is in a very special position to benefit from this data paradigm shift and data explosion of data storage growth. So in terms of price chart, yes, they're not like they're not like petrochemical. In fact, they have been on the uptrend for many months already. But if you look at the investment merits, look at the quantitative merits, they are again a net cash company as of 2020, as you can see here. In fact, before 2020, they are close to net cash as well, which shows that they have a very strong balance sheet. They have a very strong cash flow. They have a very strong cash flow generated from operations. All right, which means that they are very resilient as well. So as long as this data paradigm thesis remains intact, right, we believe that the value of the company should rise according to the industry, right? But how far they're gonna go, again, is a question that is in all our minds. But we believe that in the future, in the near future, at least in the next 1 to 2 or even 3 years, right? If you look back to the price today, I'm quite confident that I myself would say it was cheap, or it was affordable at this time. Okay, so I think I guess I'm almost time's up, but I just probably want to close my talk tonight about what kind of portfolio allocation strategy that I can follow or execute, in a post-pandemic investment world. Okay, so I think I shared this before about what are the strategies based on risk appetite, how you can structure your allocation, right? Whether you're passive, conservative, aggressive, or balanced, right? So we basically categorize our stocks to investment grade, or passive value stocks, to thematic cyclical stocks, to speculative. Now, what we have done so far, so this is a year to date. So this is one of the model portfolio. This is a 4 million ringgit portfolio. We started this year. Okay. Now, the blue on the top chart, the light blue is what we call the passive or the investment grade or value stocks. The green ones are the thematic cyclical stocks, all right? And then the orange is speculative. Now, what you can see, actually, we have a lot of allocation on the thematic cyclical, right? And not so much about on the value stocks, and only a little bit on the speculative. Now, what's going to happen is as market is become more and more volatile, right? What is going to happen is we may want to reduce our exposure on the cyclical thematic stocks. I think a lot of our cyclical stock like steel, like oil and this petrochemical has actually gone up. So we want to take some profits and maybe rebalance our portfolio to value stocks. All right, which we have talked about even in our other webinars. So in terms of allocation by industry, you can see actually very clearly that we are still very much invested in tech. Tech is actually, in the deep blue color here on the bottom chart, then followed by petrochem, followed by steel, stocks, followed by oil and gas, followed by others, right? So we were quite concentrated on technology stocks at the beginning of the year, which had a good run. So the blue line is actually our year-to-date return of our portfolio. I think recently it's taken a beating because of the market correction, especially on the tech counters. But we actually reduced our technology stocks exposure from about 50% to about 40% recently. And with the correction across the technology board, we believe that value is emerging, and we may want to increase our exposure on technology stocks in the next coming few months. All right. If you ask me, hey David, why are you investing in oil and gas stocks? Since it's so volatile, and oil and gas stock again, petrochemical, steel, and oil and gas is part of our recovery theme for 2021. And particularly for oil and gas stocks, the reason why we invest in some oil and gas stocks in Malaysia is purely for hedging against geopolitical tension. As you know, when the new president came on board, and things are not getting better as in the world, especially in the Middle East. So we thought that there is a good chance some of these tensions may escalate into physical wars, or not, is what we have seen in Israel and this Palestine, right? So our oil and gas allocation is purely our hedge against these geopolitical tensions. But again, as I mentioned just now, we may want to increase our allocation on value stocks, dividend paying, or even investment grade stocks moving forward, as we see more volatility in the stock market in the coming few weeks to months. Okay, so I hope that I've given you a good rundown of what are the investing opportunities or ideas for you to invest in a post-pandemic recovery world. Just a word of caution: we are not entirely out of the woods yet. The economic recovery is still not a sure thing. So hold on your horses. Make sure that you do your homework. Then at least when the time comes, where you put your money at. Okay, so with that, thank you very much. Shane, back to you.
Thank you so much, David, for sharing with us your perspective on the global economy recovery and also in Malaysia's potential opportunities. But I just want to do a quick shout out is that I want to reiterate the point that whatever discussed on this Bursa webinar is only for educational purpose. No any recommendation to buy or sell any companies. Okay. So yes, you have any questions for David, you may ask in the Q&A box, and then we can better manage it. Okay, right in the Q&A box. Okay. Now, of course, I have seen a few questions already about petrochemicals. I think let me sum out some of the questions. Some of the participants here are concerned about supply for the petrochemicals in the global market far exceed the demand, and also there are some concern on the average selling price of petrochemical products. So would you want to talk more about this?
Well, actually, the demand for I beg to differ. The demand for petrochemical is only going to go up as long as the economy is recovering, right? In fact, the demand for petrochemical, as shown by this slide here, is going to grow even bigger. All right, they're going to be more and more important. Because of a lot of more and more products around what we are using today is dependent on petrochemicals, not just plastics. And in terms of ASP, right, I can tell you ASP is so hard. It's actually a lot of these petrochemical companies, they are enjoying all-time high ASPs as of these few weeks. Other than petchem, we are also following a few other petrochemical companies in Malaysia, including Lotte as well as Samchem. But of course, Samchem is different because they are not pure petrochemicals producers. They are more of a distributor as well as blenders. Okay, so from what we learned from the management recently in the latest analyst briefing, right, they're enjoying all-time high ASPs. In fact, we even got to know that sometimes the ASP is like changing every day as well, just like what is happening to the shipping industry recently. Yeah. So I hope I answered that question, Shane.
Okay. There are also a few questions asking, what do you think about comparing between the Lotte Chemical Titan versus the Petronas Chemical?
Both of them, actually, the business of Lotte and petchem are quite similar. The only difference is traditionally petchem derive their feedstock from gas, all right, whereas Lotte is from naphtha, the output from the oil refineries. But with Pengerang, I think Petronas petchem is also venturing into naphtha as one of the feedstock when they go into these specialty chemicals. But in terms of risks, in terms of resilience of the business, in terms of balance sheet, or in terms of management merits, right? I think petchem is, I guess on a risk scale, petchem is on a lower risk compared to the Lotte Chemical counterpart. And don't forget, Lotte Chemical is actually owned by the Lotte Group. They recently re-IPO, I think just a few years ago. And of course, the latest quarter was very, very strong result because, with high ASP, higher demand, right? Hopefully, their turnaround is substantial. To me personally, I will categorize, let me come to here. I will categorize petrochemicals as an investment grade stock. All right. So this is business aside. This is we're talking about the risk category now. So thank you for that question. Petrochemical will fall on between the blue, as I mentioned. Petchem is an investment grade company, but a cyclical business. So they are in between this blue and green, whereas this Lotte Chemical is more speculative because they are at best turning around the business. Okay, Shane.
Okay, cool. Yeah, somehow we have to appeal the nationalistic spirit. Sokong Parang Patan Malaysia. Okay. All right. So next question. I think also there are people who a few people asking for you to compare between the other hard disk players such as JCY and also
I think Penta or JFTech, right? Is that the question?
No, comparing the Dufu and Yeah, the HDD.
JCY or Notion VTech.
Notion, yeah, Notion.
You have to understand the business first. Actually, how do these companies make all these components is through this process called CNC machining, right? I think it's called computerized numerical. I forgot the entire term, right? But it's basically CNC machining. In terms of products, JCY, in my personal opinion, they are also not a bad company, but they produce different parts of the mechanical parts of the hard disk, and I personally favor Dufu more because of the reasons that I outlined here. Notion VTech, they're more diversified. I'm not sure how big is their hard disk segment in the business. I understand that they actually diversify into other businesses like EMS, as well as even gloves, right? Did they? No. Is it gloves? Yeah. I forgot what they ventured into. Yeah, because I didn't follow Notion for quite some time, so apologies for that.
Face mask.
Sorry, face mask. Sorry, thank you very much. Face mask. Sorry. please don't sue me because I really don't follow this business. Right. But after weighing the merits, the qualitative merits as well as qualitative and quantitative merits, we at Spartan Group, we tend to favor Dufu more, and we believe that Dufu has a better chance, to benefit from the whole data paradigm shift. Now, just give you an example. One of Dufu's biggest customer is actually Seagate. Yes, they have other customers at Western D as well, but the biggest customer is actually Seagate. Now, if you can, right, maybe after this webinar, you go and look at this price chart of Seagate. And if you can, go to their website and download their latest earnings guidance or their earnings, their presentation or the investor relation presentation. You will understand why you will understand why we choose this company as our choice of stock to benefit from the data paradigm shift. Okay, Shane, I hope I give enough to tease the listeners to actually do more homework on their own, other than getting the answers from us.
Okay. So yeah, there are also people who ask about, what do you think about glove sector? Is this still relevant, considering the fact that the rising COVID cases around the world?
You see, the importance of glove is still going to be there. The usage of glove is never, nothing has changed, even pre-pandemic or post-pandemic. But what has changed is actually the supply and demand balance. As we know, that because of this pandemic, there are more new players, glove producers just popping out like mushrooms. Not just in Malaysia. In Malaysia alone, right, we have so many new players coming online, coming on stream, right? In fact, from other countries as well, look at Thailand, Sri Lanka, we look at China, I forgot the blue, something I forgot the name, Incor and blue something, and just China alone, right? The capacity in the next 2 years is going to overcome top gloves capacity in the next 2 or 3 years. So this is something that we have to look at carefully. And other than that, there is also that will definitely have a downward pressure on the ASP. So I personally do not believe that the ASP is going to go back, to the heydays back in 2020, where, spot rates are commanding $200 per carton or things like that, right? I think those days are far behind us. ASP is definitely going to normalize. And other than that, we also have the ESG angle to take care of, because I think for all the bad reasons, a lot of our glove players are thrown into the limelight because of, social responsibilities, how we treat how a lot of these companies treat the laborers, their working condition, So this will have definitely a negative impact on their valuation as well as their business outlook. So because Western countries, they are very, very serious about ESG, especially on the social responsibility, right? So if one company say were exposed, they did not treat their laborers properly or whatnot, right? Or they did not treat their waste, properly, right? They will shift the orders to other suppliers, maybe out of Malaysia. So this is a risk that we definitely have to look at. Hopefully, answer the question.
Okay. Felix would like to ask you, recently market is very worried about inflation. So do you think the inflation risk is likely? Will it cause another sell down, especially towards the technology sector due to their high valuation?
Yeah, yes, as I mentioned, for 2021, we believe that one of the main themes or main concern will be inflation. But whether we will advance to hyperinflation I think is still very far. It's still not too obvious yet. Right now, the tech sector, actually the problem with tech sector is the valuation, because tech sector has, as I mentioned in one of my slides, has grown so much, right? Some of the stocks has even more than doubled out, right? I think it's quite timely for them to experience a correction already. Actually, we welcome the correction. I think just barely 2 months ago, right, we were saying to ourselves, ayo, tech stock, how to buy? Tufu, how to buy? Penta, how to buy? But these days, you see, a lot of these are dropping, and as I mentioned, we are long term. We are in a long term game when it comes to technology stocks. So we welcome this correction. How long or how deep this correction is going to be will depend on the market appetite. All right. One of the things that I mentioned in my earlier slides is actually the decoupling of the big tech in NASDAQ. So the big tech are like the Facebook, Amazon's, Netflix, Microsoft, right? And when this happens, right, because all this anti-trust legislative that is introduced by the lawmakers in the US, right? So I think this will again be the next really big shift in the tech space. So we are actually waiting for that to happen, and we believe that when that time comes, right, there'll be a lot of opportunities for us to invest in. So for the time being, yes, valuation is a concern, but when it comes to business outlook, everything is still rosy as far as the tech companies that we invest in. So we welcome the correction at the moment, and we hope, as I mentioned earlier on, in my concluding remarks, we actually hope to increase our allocation on tech to more than 40% in the coming weeks or even months. Thank you.
All right. Let's do one last question by Jin Yuan.
All right.
Just really brief. Notice that you review your portfolio weekly dynamically. May I know the stock that you took up here are the best leader in that particular sector?
Yes. One of the criteria, the qualitative merit, is when we look at the sector or top down, right? We usually like to invest in companies that are the leaders in that particular sector or even subsector. For example, petrochemicals, right? Yes, there are a lot, there are petrochemical, there are these Panama, Lotte, LC Titan, Samchem, Luxchem, so many petrochemicals. So why do we look for why do we invest in petchem? Because of the qualitative merits as well as they're the leader. So and it's not just apply in petrochemicals. In fact, we apply almost the same principle in almost all the sectors that we invest in, including steel, including technology as well. So technology stocks, I think, as you know, I've talked about Inari before. Inari is the highest, is the largest by market cap listed in a KLSE. So definitely Inari is in one of the dark blue allocation here. Yeah. Other than that, then we have other things like Dufu, we have VS, Unisem as well. Yeah.
All right. Thank you so much, David, for sharing with us your insight and perspective into this.
All the best to your to Life Chance listeners investing in a post-pandemic world. Yeah. Thank you.
Yeah. Thanks everybody for tuning into these sessions. Okay, so before we leave, just let me tell you more about our next webinar. So just give me a minute.
Sorry, I need to unshare, right? Yeah, got you.
No, you don't have to. Okay, I can control. All right, so our next webinar is going to be on Iliad wave. All right, so the session is conducted in Malay. So Iliad wave dan implikasi di Bursa Malaysia is happening this Friday, 21st May 2021. So for those of you who have not known or have not mastered the skill in Iliad wave, we have invited a very experienced certified Iliad wave analysts, okay, to come to this session to teach about Iliad wave, okay, and the application. Okay, so I've just given you the link in the chat box. So if you want to learn about Iliad wave technique in technical charting, please sign up for this session, because we have got someone who is certified in Iliad wave and he teach Iliad wave in Malaysia. Okay, so please sign up for this session if you want to learn more about Iliad wave, happening this Friday, 2 days later, at the link that I've just given you in the chat box. So with that, thank you so much, David, for joining this session. I hope that all of you here have gained an enormous value from this session, investing opportunities in the post-pandemic world, and hope that, of course, we can go back to we can go back to the situation where the COVID-19 pandemic is very
Over.
minimal.
Yeah,
it's
so
over.
please all of us do our part to stem the transmission of the virus by staying at home and don't simply go out. Yeah, thank you very much. Take care, guys.
Yeah, so that our life can be back to normal. All right. So with that, thanks everybody, and have a great rest of the day.
Okay,
Bye
good
bye.
night. Bye bye.
This is Xuan Zhu signing off. See you in our next webinar.